This is the Value Investor Podcast with Tracy Reinick. All things value, all the time.
Welcome back, value investors. So I wanted to take a look again at the Magnificent Seven stocks. I've talked about them when they were the FANGs, when they were the FANG Men, and now they're the Mag 7. And like I said, I've talked about them many times on the show, even though this is the Value Investor Podcast. So why would I be talking about any of these big cap tech type of companies? And the reason that I've talked about them is because over the years, there have been buying opportunities in many of these stocks. Obviously, nothing goes straight up. No stock rises forever. There have been sell-offs like we saw in 2022 in the overall market. Many of the Mag 7s also sold off then. They sold off in the pandemic sell-off in March 2020, and numerous other times throughout the last, say, 7 or 8 years since I've been doing the podcast, we've seen some individual sell-offs. So there have been some times where it appeared that some of the Mag 7s seemed kind of cheap. And I've said also over the years that just because you're a value investor doesn't mean you shouldn't own growth stocks. The key is to get them as cheap as you possibly can, or even a value that has growth. That's the ideal. But for these big cap, FANG or Mag 7 type companies that just about everybody owns or wants to own in their portfolio, it's not a bad idea to still be in one or two of them, still own them in some kind of index. If you own the S&P 500 or the QQQ, you already own all of the Mag 7 and in a big quantity, in fact, too. But if you owned a semiconductor ETF, for instance, or maybe a software or, any of these kind of more niche indexes, you also own them. So we all do own these companies in some form. Somewhere we're going to own them. But we occasionally do want to own the individual stocks as well. And so that's why I wanted to take a look today to see, are any of them cheap? Here as we're going into the next earnings season in October of 2024, and then we're going to have the end of the year push. And many of these companies are now involved in AI and everything going on with that. So who is cheap? Or if any, are any of these cheaper? And which ones should I kind of have on my watch list if I'm not in them, and wait to see if maybe there is some kind of pullback here this fall, as some strategists are predicting. Who knows on pullbacks? You can't always time them well, but I just wanted to look and see what is going on with the Mag 7. What are the cheap ones, and should we be into any of these? So I just went down the list. There are 7 of them. Obviously, it's the Mag 7. They are Meta Platforms, Alphabet, Apple, Microsoft, Amazon, NVDA, and Tesla. It's the reason why we no longer have FANG Man is because Tesla had to get in there some way. So that's how we got the Mag 7 now, is because Tesla. But this is still obviously an interesting list. On this list, I personally already own Alphabet, Microsoft, and Amazon. So I don't own the others on this list right now. And I've owned all of those for quite a number of years. And I have been buying and selling them over that time period. I have taken some profits off on a couple of them, but I still own positions, and Microsoft, I added to that position last year in 2023 when the whole Chat GPT thing exploded, and I knew they were involved in it, and I wanted to own more. So I did buy some in the spring of 2023, some more at that time. But otherwise, I don't own these other ones, and maybe I should have them on my watch list too. And so I just basically looked on Zacks.com at each one of these stocks. I checked out what their Zacks rank was going into this next earnings season. And I looked at PEs, price to sales, and then I took a look at the earnings growth to kind of see what was going on there. And now, also surprisingly, a lot of these stocks are now paying a dividend. Like, that was weird to me. I think the last time I did this kind of episode about the Mag 7 on the Value Investor podcast, I'm not sure many of them, other than like Microsoft, was even paying anything really back then. So now we have like a whole new world where a bunch of them are actually paying something. So what does that mean? Is that good or bad? But if you are looking for at least a little added bonus of income, you can now get that with some of these stocks as well. So that's all I looked at. I did not obviously screen for any kind of Zacks rank because why would I? There's just 7 stocks. And I was curious to see. We have no Zacks number 1 ranks with any of the Mag 7s right now, but we are just ahead of earnings season. So some of those old estimates are falling off. And obviously the analysts are not having any motivation. There's not been any announcements about anything to raise their earnings estimates. However, one of the companies, Microsoft, is a number 4, which is a sell. And I had to go look to see how did they get the number 4. And there is one estimate that's been cut for this year and next year in just the last week on Microsoft. None have been raised. So the Zacks rank looks at that and says, oh, all the analysts are in agreement and it's negative agreement. And so they're cutting. And so we're going to give it the lower rank. So that's how it got the 4. It's not at the 5 yet. But if you suddenly were to see, 5 estimates being cut instead of just the 1, that you would be more likely to get that strong sell designation. But some analysts is adjusting their full year earnings estimates ahead of the earnings. And that's always interesting, either adjusting it higher or lower, because the analysts don't like to be wrong. And they usually will just wait on the sidelines until the earnings report and then be like, oh, I was too conservative, or, oh, I was, over optimistic. And then they will cut after the earnings. But it takes a lot of belief in what you think the company is doing to actually adjust ahead of time. And we're getting those earnings in just a couple of weeks now. So one analyst out there is a little more bearish right now, but still overall, the picture looks pretty good for Microsoft. And I will have more on that in a moment. So what is the cheapest? Should we start with the most expensive and then end up at the cheapest? I think we should. And I know what you're thinking, like, oh, the most expensive has to be NVIDIA, because NVIDIA, has been on such a tear. The shares are soaring. They seemingly were hitting new highs every day earlier in the year, but they've been treading water again recently and up and down. And there have been some buying opportunities in there. But meanwhile, the earnings estimates actually are still going up. NVIDIA is a Zacks number 2, which is a buy. And so the analysts are still bullish there. And for that reason, some of its valuations aren't super stretched here. Believe it or not, NVIDIA is not the most expensive. But what is? Well, let's use PE. We could use price to sales as well, but I'm gonna use PE because that's the fundamental most value investors do look at. But price to sales also very important and key. We use that many times here on the show as well. So I'm gonna tell you both, but I'm gonna use PE for the cheapness factor. And we're going to start with the most expensive one, and it is Tesla, ticker TSLA. PE is at 113 right now. And some of that is because this year's earnings don't look good. Earnings expected to be down 27% for year over year now. And we just got some new data in about car sales, I think for the third quarter, and a little light on the car sales. And so those earnings have been coming down as it's been, a little weaker here, even with the Cybertruck launching. So 113, but price to sales ratio not as terrible, just 8.7 there. 2025 earnings look better. Analysts for now expecting a rebound of 37.8%. But now that we just got some more car data out, and then we're going to get the earnings report soon, a couple weeks again for the earnings, then this could all change. And maybe they get more bullish about next year, or maybe they get more bearish. We shall see. So Tesla, Zach's number 3, it's a hold. Analysts are just kind of waiting on some more data, but the car sales data, not so great. And it's already very expensive here. So this is the most expensive out of the Mag 7. Shares have rallied in the last couple of months, but we'll see if they can hold that, or if, we'll see some profit taking. So that's Tesla, ticker TSLA. Okay, then on a PE basis, I keep having to switch over my sheets here. NVDA does come in at number 2 on the expensive factor, but not as bad as you might have thought. On a PE, it's trading at 41.5 times. So that's a lot less than even a couple months ago when it was in the 50s. And I didn't think it was that it was that expensive then either, but now it's at 41 times. But price to sales is where it's at, and it's extremely expensive on price to sales ratio of 29.8. So that's way up there. But fiscal 2025 earnings expected to be up 116% still. 2026, 32.8%. So they keep beating and revising higher on earnings and sales. So they still have it. They do pay a dividend, but it's yielding just 0.03%. They only pay 4 cents. So it's just kind of to make the income category, basically. But it's not enough to have any real meaning. So you're not buying it for the dividend, obviously. It is a Zach's number 2 rank, a buy. So that's encouraging going into this next earnings report. But the analysts have been behind on NVIDIA for about 18 months now, even though the company has beat and raised every quarter since then. But everybody is still behind the times on what is actually going on with earnings. So NVIDIA still one of the winners out there. Revenue for fiscal 2025 expected to be up 103%. And for a company of this size to go from 60 billion last year to 124 billion this year is just an incredible thing. And I've said this on various of my podcasts now, but we will likely never see this kind of growth again. At least it's going to be a while. These are when there's some kind of huge new industry. We might have seen this during the internet, the start of the internet. And now we're seeing this at the start of the AI revolution. And these numbers are just incredible. And I like looking at them. So NVIDIA, if you're not in it, it's not that expensive on a PE basis, but price to sales is very stretched. But for now, it still is actually executing and doing what they say they're going to do. So NVIDIA, ticker N as in Nancy, V as in Victor, D as in David, A as in Adam. Okay, then the third most expensive stock is Amazon, ticker AMZN. PE right now is at 39. But remember, for 20 years, the PE was over 50. I think this is the lowest I've ever seen its PE. I don't remember it ever being in the 30s before. So that's impressive. It keeps coming down while the earnings has now turned around. They had a few rocky years there just a few years back after the pandemic was fading, and earnings did decline. But the new CEO, Jassy, has turned it around, and now earnings expected to be up 63% this year, another 23% next year. It has a price to sales ratio, which is the lowest among the Mag 7 now, of just 3.2. So that's low. I would, a real deal would be anything under 2. But 3.2, still cheap for one of these types of Mag 7 type companies with their hands in tech, retail, movie studios, like all this stuff. So I'm liking Amazon here. It's the Zacks number 3 hold. So we'll wait and see what happens on its earnings report. But Amazon kind of being left out of the discussion because it's not a huge AI player. And it has double-digit sales growth, but not, triple digits. It's supposed to grow sales 10.4% this year and 10.7% next year. No dividend on Amazon. Okay, now we're getting closer to the cheapest stocks, right? But number 4 on the list of the more expensive, but I would put this in the middle of the pack now, is Microsoft. It has a forward PE of 32.3 and a price to sales ratio of 12.7. So last year when the AI revolution busted out and the shares spiked up, a lot of discussion was around this price to sales ratio because it did spike over 10. It's remained over 10, and 10 and above is considered to be expensive on any kind of technology company, any company for that matter, but certainly on even the tech companies. And the last time Microsoft was above 10 on price to sales ratio was at the height of the dot-com boom. And we all know kind of how that ended. It did go lower. It did fall under 10, but it took a number of years and for the stock to really contract and fall. And then you got the better valuations. So it's making people a little nervous that it's back over 10 now. Like I said, it's the Zacks 4, which is the sell because some of the estimates have been cut, but earnings expected to be up 10.5% this year and then 15.2 next year. The thing with Microsoft is it's spending a lot of its money now, a lot of its cash on AI, building out the data centers, ChatGPT investments, a lot of investments that may not be paying off yet in actual revenue. But revenue growth for fiscal 2025 expected to be up 13%, and then basically almost the same for next year, again, another 13%. These numbers are still really impressive to do double-digit sales growth for a company of this size. The trillion-dollar market cap companies, when they've been around for almost 30 years now. It's been almost a public company for almost 30 years or almost 40 years. Sorry, almost 40 years now. That is impressive to still be doing double-digit sales growth. So that's why I like it and that's why I own it. But it is not among the cheapest here with that PE of 32 times. So that's Microsoft, ticker MSFT. Then we have Apple. Apple hasn't been cheap for a while. We have Warren Buffett selling huge stakes of it in Berkshire Hathaway now. Is that sending a signal that it's overvalued? We don't know, but he has been cutting back his position. It has a PE of 30 still, but the real kicker is that it doesn't have the double-digit earnings growth. So earnings expected to be up 9.3% this year. That's a little better than it was. A couple months ago, they're only looking at single digit, but lower single digits, 4 to 6%. But now it's looking for 9.3. And then next year, Next fiscal year, 12.6. So nice to see that rebounding a bit. And I think the analysts are getting a little more bullish because they are going to be rolling out those phones with the AI features. Will that be a big catalyst? We'll see. But revenue is the side I don't like with Apple. So this fiscal year up only 1.9%. But again, Apple's been around forever, even longer than Microsoft. And to do double digits after all those years and at this size of a company would be pretty impressive. And right now, Apple cannot do it. So just 1.9%. Sales growth this year and next year, 8.5. So they are looking for improvement next year. Price to sales ratio on Apple is 8.9. It's not over the dreaded 10, but that's certainly not cheap. So a PE of 30, price to sales of 8.9. Value investors not really interested in it here. Does pay that dividend, but it's yielding only 0.4% right now. That's not that great. It is a Zacks number 3 hold, as many of these are, because we're just waiting for the next earnings report. So we'll see what they report coming up here in a couple of weeks, but they're not cheap and they don't have the growth. That's like a bad combination. You want cheap and growth. That's the rare good combination, but expensive and no growth or low growth is not great. So Apple, AAPL is that ticker. And but they are among the cheapest of the Mag 7 still, even though it's expensive. Okay, so we're getting towards the end here. Who is the second cheapest stock? So it's not leaving many options, right? There's only 2 left. But the second cheapest is Meta Platforms, ticker Meta, META. PE is now at 27. It was in the lower 20s not that long ago, a couple months ago, but the shares have rallied, so it's gotten a little more pricey. PE of 27. Price to sales ratio is at 9.7, so just under that dreaded 10 level. So that's not too cheap on the price to sales either, but PE not too bad. Earnings looking good. 2024 earnings expected to be up 43.6%. Wow, that's stronger than I would have thought. 2025 up 12.8. So nice double digits on both of those for the earnings side. They do pay the dividend now. I always forget this. Like I said, some of these are new on the dividend scene. It's yielding the same as Apple at just 0.4%, but at least it's something. We're getting a little bit of extra. And as we know, any little bit of extra, even just 0.4% over long periods of time, can really up your total returns. It compounds on itself year over year. So just that little bitty extra can really send your portfolio higher. So don't laugh at it. Don't mock it, because you might be pleased after 10 or 15 years of a stock that's paying you a dividend, even if it's yielding under 1%. Okay, so what does the sales look like? I haven't looked at their sales in a while. So that's looking really good. Double digits for both this year and next year, 19.8% this year. Wow. And another almost 14% for 2025. So Meta Platforms not getting as much attention as some of the others, but the shares have busted out again and are at what looks like new all-time highs. New all-time highs for Meta, and now trading around 27 times. Is that expensive? With the 9.7 price to sales ratio, but double digits on both earnings and sales. Not that expensive, and it's got the growth to justify it. So that's Meta Platforms, ticker Meta, META. And then the cheapest Mag 7 stock of them all remains Alphabet. Ticker GOOGL is the one I use. PE of just 21.9. So that still remains low. It has been a little bit lower this year. It's been as low as like around 20 times, or maybe it was even 19. And that's when I was doing the video or these podcasts of, Warren Buffett should buy some shares in Alphabet because it was attractive, especially with like the PEG ratio. Its price to sales ratio is also still attractive, especially for a tech company. And that is 6.3, not as low as Amazon at 3.2, really cheap, but still 6.3, nobody's freaking out saying, oh no, it's doomed or something at 6.3 like we would if it was over 10. So that's attractive. They are also paying a dividend now, and it's yielding 0.5%. This is the highest paying dividend payout person. And so I'm liking that. It's number 3 on Zacks, but again, we're waiting for the next earnings report. That's just the hold. 80% of all Zacks ranked stocks are in the number 3 category, remember. So nothing shameful about number 3s. And remember, the Zacks rank can change daily. So it will change a lot during earnings season as those earnings estimates revisions from the analysts come into the system. And so that's when we'll get all these changes. Oh, did I say Meta Platforms was a 2? They are a 2, a buy right now. So, and that's ahead of earnings. So something good must be going on there to get the number 2. But Alphabet's got the number 3. Earnings expected to be up 31.6% this year on almost 14% revenue growth, and then 13.2% for next year on 11.5% revenue growth. So a little calmer for next year if that holds. But I'm liking it. Again, double digits sales growth and earnings growth. You like to see it with these big cappers. How long they'll do it, I don't know. Amazon or Apple has stopped doing it for now, but these are just incredible numbers that we're seeing. Okay, I'm looking down to see what's going on with Meta, how they managed to get the number 2. Well, one estimate is up for next year in the last 30 days, and the Zacks rank is looking a lot at next year already because we're in the second half of the year, so they're looking forward. And is that enough to get it the number 2? I guess so. Nobody's cutting. So we have one raise in the last 30 days for next year. And the Zacks consensus is up a little bit to 24.10 from 24.07. So up 3 cents over the last 30 days. But again, the algorithm's just looking that it's going in the right direction, which is higher. It's seeing revisions up, and the actual consensus estimate is on the rise as well. So, and that is happening with Meta. So there you have it. The cheapest of the Mag 7s is Alphabet, followed by Meta. Then we had Apple. Then we had Microsoft. Then we had Amazon. Then we had NVDA. And then we had Tesla. And strangely, this is like the exact order I looked at these stocks. So almost the exact order. So that's weird. But as I said, these numbers are always changing. Nothing here is dirt cheap, obviously. But some are more attractive than others, especially comparing the peers, which is what the Mag 7 does. These are all peers now of the Mag 7 club and the $1 trillion market caps with some of them, and AI with some of them, or just innovation with all of them. And so who is the cheapest among their peers? Alphabet. And even you might want to look at that price to sales ratio of 3.2 on Amazon and say that it could be Amazon as well. So both of those of the cheapest. Keep an eye out on the conference calls and the earnings reports that we're about to get on all of these. That's going to be vital as always. And otherwise, you already own these stocks if you own the S&P 500, and you own big chunks of them already. So be diverse. Don't have all your eggs in one basket. But I do believe that value investors should own some growth names. It doesn't have to be the Mag 7, but you should have a variety of both value and growth. If you can get the growth cheaper, then even better. And some of these are looking fairly attractive. So keep those things in mind. And again, be diverse. Okay, let me recap all the tickers. Even though we know them, just going to recap them. So we had Meta Platforms, ticker META. We had Alphabet, GOOGL. Apple, AAPL. Remember, it's AAPL. We had Microsoft, MSFT. M as in Mary, S as in Sam, F as in Frank, T as in Tom. That's a little bit of a tongue twister there for Microsoft. MSFT. Then we had Amazon, AMZN as in Nancy, AM as in Mary, ZN. Then we had NVDA, NVDA, and we wrapped it up with Tesla, the most expensive of the group. T as in Tom, S as in Sam, L as in Larry, A, TSLA. And I'm going to be watching all of these this earnings season, as I know you are too. But be sure to subscribe to the Value Investor Podcast, so you're getting value stocks every week, or at least stock ideas. And you can get us on Apple. We're on Spotify. We're on YouTube. Just go to Zach's podcast. We're on SoundCloud with the Market Edge podcast. And we're on basically all other podcast platforms. You can find us. Just put it in, search for us. You will find a podcast somewhere. Be sure to subscribe so you don't miss a single episode, and I will see you again next week with some more value stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.